This is alarming. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, startling evidence indicates the demise of the U.S. economy has started. And this is contrary to what we're hearing from the political elite and the banking elite, that we're likely to have a soft landing and that the U.S. economy is going to come roaring back by the second half of 2024. But we have new evidence as of today that suggests that any notion of a soft landing is out the door and that the demise of what we know as a booming U.S. economy is over, as we likely now head into a recession. Now let's head over to Bloomberg, where we picked today's story up with a headline: spot container shipping rates soar 173% on Red Sea threat. And this is just one of the things that happened, but this isn't the only one. There's something that happened today that was far bigger, far more severe, because we know that once the issues in the Red Sea get dealt with, that of course shipping rates will come down. But there's a short-term problem here that has long-term consequences, and we know that when shipping rates go up, well, that means the cost of goods goes up as well. That back feeds into inflation. Of course, we know the Fed doesn't want to see inflation go any higher than it already is. As services from Asia to Northern Europe and to the Mediterranean both cost more than twice their levels in January 2019. But what the good news here is they're still well below their peaks during the COVID-19 pandemic. The problem we have here isn't that they're lower than the COVID-19 rates, is that they're going back up. And that is an issue here because, again, the price we pay at the end user as consumers, well, shipping has to get factored in here. And if anything puts upward pressure, even worse as you're about to see sustained upward pressure on those prices, means that inflation isn't going away just as quickly as some people think. For cargo owners seeing their freight costs rise, the risk is that spot rates will stay elevated and leave them with less leverage when they're negotiating long-term contracts, which typically takes place between March and May, as most ocean freight moves on rates set on these contracts. And that would be a huge problem, as we see that these rates could get locked in. Then as issues in the Red Sea get resolved, prices would come down, but these contracts would already be there. And that means inflation gets embedded into prices at a time we already know that consumers here in the U.S. and around the world are absolutely struggling to make ends meet, let alone continue to pay higher prices. They need price growth desperately to slow down, because one thing we're not seeing that we'll look at later is that wage growth is keeping pace enough so people can afford the standard of living that they want. And here's the evidence that this could be a big problem for the inflation picture. As we look at the consumer price index in blue against the import price index for all commodities, that showed in red on a year-over-year rate of change. And we can note the beautiful relationship here where import prices, and this makes sense because we have that data, and then it feeds into, of course, consumer prices when we see those transactions happen on the consumer level with a lag, that where import prices go, consumer prices typically follow. And this suggests that, of course, import prices likely to head higher. Of course, there's one case that would change that whole picture, and that is if demand comes crashing down. And we know that is a likely case because consumers are already balking at higher prices. Anything that pushes prices up even higher means demand is going down. But the short-term problem here is that the Fed could have an adverse reaction to this. As the Fed sees rates staying high for some time, with cuts eyed in 2024, of course, we know behind the demise of the U.S. economy, you can always find a central banker, as participants view the policy rate as likely at or near its peak for this tightening cycle, according to the recent minutes from the last FOMC press conference. Now, this is good news because what the market's looking at here is saying the Fed has reached their peak level, that they believe that rates are finally restrictive enough to bring inflation down. Of course, one thing we note is there's very little, if any, correlation, as you'll see in a chart here in a little bit, between the cost of money, which is, of course, the federal funds rate, and consumer prices. The notion that there is even a relationship here is somewhat ludicrous. but to the Fed, it's all that matters. Of course, as we know, it's one of their only two policy tools, so it has to matter in a big way. But as far as market expectations go here, the issue is they want to see rates come down, because if that happens and inflation comes down, well, the market believes that's the soft landing. But as you'll see, we have some new evidence that shows the demise of the U.S. economy is indeed coming this year. And that said, officials reaffirmed that it would be appropriate for policy to remain at a restrictive stance for some time until inflation was clearly moving down sustainably. And this is a story we continue to get from the Fed, that rates are going to stay higher, they're going to stay here longer until inflation gets down to their 2% target. Now keep in mind, the CPI on a year-over-year rate of change is right around 3.1%. Of course, we'll get some new information on that, and we may see it tick up a little bit, but what we're looking at is the trend. And in the 6-month trend right now, well, the consumer price index is actually trending just a bit below their target, suggesting that we continue to put in some low month-over-month prints. We'll be right at 2% and then even lower in the near future. The mints indicated increased optimism among participants about the path of inflation, noting clear progress. The committee expressed a willingness to cut the benchmark lending rate in 2024 should that trend continue, though they gave no indication easing could begin as soon as March, as of course as the market expects. And we know the market is usually right here, because even though the Fed claims they're data dependent, they're more reactionary to the market, and of course the 2-year Treasury yield, which has been declining. The notion here, of course, as we look at what the Fed is concerned about, they're looking for clear progress. Well, the question is, have we gotten it? The answer is absolutely. In fact, there should be very obvious by this chart alone of the consumer price index that we have made clear progress at bringing inflation down. The fear the Fed has isn't that the inflation's coming down, that their model suggests that this is going to look like the 1970s, where you're going to see a big pullback in inflation and then a huge surge higher. But as you're going to see here soon, that is highly unlikely, because based on what we're seeing now and based on what these central bankers have done, inflation is indeed coming down. The problem is it's going to bring the entire economy with it. And in their submitted projections, almost all participants indicated that, reflecting the improvements in their inflation outlook, that their baseline projections implied that a lower target rate for the federal funds would be appropriate by the end of 2024. And this is something that the market loves and the market reacts to, because what it's telling the market is, hey, you know what? We believe that we raised the federal funds rate to a restricted level. We're agreeing that we moved it too high and that we're going to lower it down. Of course, many people believe that when the Fed lowers rates, it injects money into the system, and that money magically gets into equity prices, and somehow it causes them to surge. And on top of that, what it does is it starts to populate the belief that the soft landing is real, and that all it takes is the Fed to ease off a little bit, and then the economy will take off. And what happened in the equity markets is we saw exactly that. In fact, what's coming here in a couple weeks that we'll talk about in a show in the coming future is why equity prices may continue to rally, at least for a bit higher. And of course, you could be taking advantage of that if you had our CTA Timer Pro, because we showed you how the machines are positioned. But one unique thing that we do that no one else does is we run a historical overlay that shows these extreme positions. And when you see them, you got to take advantage of them, because going back to October 9th, we saw the tech stocks, the QQQ, the biggest tech traded ETF, come off a massive short position. It had been coming off that for a couple days. It was a huge indicator. And many of you said, Steve, could you just show us when this happens? Could you just give us a daily report in addition to this? Yes, coming this month, we're going to make this so easy to use. And right now you can grab a free month. There's 3 coupon codes for each of these, and you pair that with our Momentum Timer Pro, you can throw away all of your other reports. Many of our subscribers say, Steve, one trade is paying for years worth of your subscriptions alone. This is fantastic. Also on October 9th, what we see, the technical indicators, which we go and aggregate across the MACD and the STOCH and the RSI and all these other ones. We smooth them out. We had one technical indicator show buy signal. And yes, on this, we're going to make it easier to use too. And right now, you'd be up 9.4%. There would be a pullback here on the price, but notably, if indeed the market continues to buy into a soft landing, what you're going to see is more money pour into the equity markets, drive prices higher before, of course, the rug gets pulled out from underneath. Of course, don't worry, our reports will show you that too. Links for everything in the description below, because here's the issue is the Fed doesn't really react to the consumer price index. They claim they're data dependent, but you can see on this chart, there's minimal correlation here. In fact, if there's any correlation, it's the Fed is cutting rates ahead of a decline in the consumer price index, suggesting that any notion that they even care about consumer prices or that the federal funds rate has anything to do with them. Again, you think about the cost of money and the cost of what you pay at the store. There's really no correlation to those at all. It's just what the Fed wants us to believe. Of course, what we know is the issue here is a reason we're facing not just a soft landing, but an all-out recession and financial crisis, what I'm calling the demise of the U.S. economy, because what do we think as here citizens of the U.S. that when things are good, the economy is booming. So anything else is darn right in the wrong direction. And sure enough, it's all because of the central elites. As Powell said at the press conference, that it was premature to declare victory. He did acknowledge the question of when to begin dialing back policy restraint was discussed, because again, this all comes back to the fact that he believes he could just pull back a little bit on the reins now and say, you know what, we're going to find out exactly that the federal funds rate is at the right level to create sustainable growth. But that is not the case at all, because what we're seeing here in these inverted money curves and yield curves is the fact that we have an issue that the Fed has inverted the money curves at the largest rate since the 1980s and at the longest rate. And what happens in a debt-based economy is when you pull back on the credit creation mechanism and then you run through all the money in the system, well, it all dries up. You start to see delinquencies pop up. You start to see defaults and liquidity crisis and banking issues. And next thing you know, the entire stock market comes falling apart. The economy comes falling apart. And there's some leading indicators, as you're about to see here in a bit, that tell us that indeed things in the U.S. have changed at a time when nobody believes it. They're so locked in to the notion that we're going to see a soft landing because the Fed tells us to, but the money curves say that's not what's going to happen at all. And here's what I want you to see. You note this is a 10-year, 2-year yield curve in red against the consumer price index in blue. We're looking at this deep inversion here in the 1980s. And what happened? Inflation came crumbling down because when you restrict the creation of credit and money in a financial-based system that requires new debt to create economic growth and prosperity, well, when you don't have enough new money, demand goes down. You can see that happen here again around late 1989 into 1990s. And what happens then? You move into the dot-com bubble. A very slight inversion leads to just an outright terror in, of course, the equity markets. We have a financial crisis under a very mild inversion here going into the global financial crisis. Go ahead into the pandemic. Look at that, just barely a smidge of an inversion. Inflation comes crumbling down. Now we have a very long, very deep inversion. Cutting rates a couple percentage points here, a couple quarter points will make no difference. We're still seeing a major issue here in the bond markets. We know that the banks now, due to these inversions, can't make money lending, so they cut back, and that means inflation is coming down in a big way. And what we're looking for is signs that money in the economy have dried up, and we got that today. As West Texas Intermediate extends losses after massive product inventory builds and large SPR adds, that's again the Strategic Petroleum Reserve. And what are we looking for is consumer demand here. So if the economy was indeed going to experience a soft landing, one thing we know is that people and businesses, they need energy. So we would look for gasoline inventories to continue to draw down. We would look for distillate inventories, which go into jet fuel, to draw down. Instead, today, we got the exact opposite, which is a huge warning sign that says the notion that we're going to see a soft landing, put that off the table. It's a hard landing if this data series continues in the direction it is. And oil prices are sliding back again this morning after surging yesterday to erase Tuesday's losses. This from Zero Hedge, as we note that a bigger than expected crude draw reported by API, the American Petroleum Institute, but notably, forget that, it's the large product inventory builds that were an issue, and this is a broad risk-off sentiment in markets to start the year, apparently to be dulling any impact from the potential supply disruptions in Libya. So what we have an issue is everyone's been focused on higher crude oil prices due to disruptions, due to, of course, Saudi Arabia trying to tighten supplies and OPEC trying to cut production. We know all that's happened. Despite that, look what happened, showed up in the data. This, again, is coming from last week as crude oil inventories declined for the second week in a row, far more than expected. That wasn't the issue. Look at what happened to gasoline and distilled stocks. The API reported almost 7 million in gasoline bills, distillates over 6.5 million in bills. Now the official Department of Energy, this isn't a minus sign, this is actually a plus. This is a typo by Zero Hedge. Gasoline inventories up 10.9 million barrels. This is the largest ever. So if you think about consumer demand here for gasoline and you get the largest bill coming out of a holiday week, that tells you exactly what something has changed in the U.S. economy. It is not a soft landing. This is not what you would expect to see at all. And take a look at distillates, because people comment and they say, look, have you been to an airport? They're packed. Yes. Well, how about a 10.9 million barrel bill to distillates? That's, again, goes into your jet fuel, the largest build since January 2019. So again, here you see what was happening in 2019. We're headed into globally synchronized recession. So this is a major warning sign that says the demise of the U.S. economy as we know it today is indeed coming this year. And we can see the effects of inflation show up as we look at the consumer price index against U.S. regular all formations gas price. That one in red, both on a year-over-year rate of change. And if we continue to see large, particularly outsized builds in product inventories, that means prices are coming down. And forget the fact that shipping costs are going up. What we're seeing now is that consumers cannot afford these higher prices. They're running out of money. They're cutting back their energy usage. And this is a huge problem because it's only going to get worse now as we get into January and the months to come, because we got to start paying on all those holiday bills. As buy now, pay later plans fuel record online holiday shopping that ramped up to $222 billion between November 1st and December 31st. This is dangerous because these discounts also drove end-of-year shopping, with Adobe reporting price cuts on electronics that were deeper than a year earlier. Toys and apparel also had significant discounts. And in an uncertain demand environment, retailers leaned on discounting and flexible payment methods to entice shoppers this holiday season. Now, one of the issues here is we pulled a lot of demand forward as we look at retailers knew that consumers were tapped out on their credit cards. They're tapped out on their store credit cards as well. And then they said, look, we'll give you this buy now and pay later. The problem is, you pay later? Well, that's coming very soon. We see this in the energy usage. If we can only imagine, as consumers have to start paying their bills into what we already know is a weak labor market, tells us that no way we're going to see a soft landing at all. In fact, U.S. companies ramped up hiring in December, this according to ADP, but hang tight. It was all the services sector, and wage growth slowed further to the weakest pace since 2021. Of course, we have noted repeatedly that if prices don't go higher, well, then you can't get to wage growth because, of course, if companies cannot charge more for their products and services, they can't pay their employees more. They don't have magic money printing machines. And here we can see private payrolls increased 164,000 last month. We'll get the official government data tomorrow, the most since August. This according to figures published by ADP. The reading came in above all but one estimate, as everyone got bullish that maybe the U.S. labor market is far stronger than you're about to see that it really is, because this was led by services including leisure and hospitality, education and healthcare, while manufacturing, which is a big one, cut jobs for a fourth straight month. And we talked about that yesterday. The manufacturing course was cutting jobs. That's going to lead to services sector. And what would we expect during the holiday season? That services would be booming. In fact, we noted that happened. But now all of a sudden, when you see this big bill in gasoline and distillates, it tells you something significant has changed. And that's going to hit the services sector in a big way. Because if people aren't using gasoline and jet fuel, it means they're not traveling. It means they're not using these leisure and hospitality jobs. those soon are going to go away. And sure enough, we can note the relationship between the economy and energy as we look at total non-farm payrolls. Again, we'll get an update on this tomorrow, and we're going to just look back here right before the pandemic so we can see the data, because it does get skewed during that period. But I want to show you that U.S. regular all formations gas price shown in red on a year-over-year rate of change against, of course, the non-farm payroll shown in change of thousands. What we note is that as energy prices tend to go down, well, the payroll reports go with it. And what we're seeing here is, again, that effect right now with these massive builds in inventories that tells us something serious is wrong with the U.S. economy, and in a big way. The numbers highlight the resilience of the post-pandemic job market. Well, at least that's what they want you to believe. And despite some signs of easing labor demand, firms are still hiring at a healthy pace. Of course, that's what the report suggested in December. Unemployment remains low. Employees continue to enjoy above inflation wage gains as well. They're only starting to enjoy it because they went 2 years on the other side of it. But what we got from the JOLTS survey yesterday is a notion that companies are not hiring and they're not laying off. They're largely holding on to their current employees. And as you can see, that's going to change in a big way, because if consumers aren't traveling, if they're not out driving, if they're not out consuming energy, guess what? That shows us they're not out spending money. It means they're running out and they're facing all these holiday bills on top of everything else. And this means everything we know that the central elites are telling us is not going to happen. Thursday's report showed further cooling in wage growth. That's a problem as new bills come in from the holidays. As workers who stayed on their jobs saw a 5.4 median percent pay bump in December, and those who changed jobs, wages rose 8%. Of course, we'll get the official figures tomorrow. And we're returning to a labor market that's pretty much aligned with pre-pandemic hiring, this according to the chief economist at ADP. And while wages didn't drive the recent bout of inflation, well, finally someone's admitting the truth. They didn't at all. Now that pay growth has retreated, any risk of a wage price spiral has all but disappeared. And that's right, we're not going to get a wage price spiral. Instead, if wages continue to go down, as I've shown you on the charts on this show, it means demand from consumers is going to go down. As spending goes down, well, the notion that the labor market has realigned, that's over too. Another report released earlier Thursday suggested the labor market cooling is largely coming in the form of weaker hiring instead of job losses, as U.S.-based employers announced some 35,000 layoffs in December, a 20% decline from a year ago, and the second lowest reading of 2023. That from Challenger, Gray, and Christmas. Of course, what did we know? What are we hearing from some of these earnings? That yes, companies are going to trim. We expect that to continue into the new year here. And as we look at the unemployment statistics, there is, of course, the one big warning sign, and that is continued claims. Now, they dropped 31,000 last month, but what did you hear in the news report? Well, that initial claims remain extremely low at 202,000, and yes, they did. The issue is we still have 1.855 million Americans sitting on unemployment, unable to gain work, and what that means is you can see, coming back to why this gasoline data matters. Here we're going to look at U.S. regular all formations gas price, now shown in dollars per gallon, against continued claims. And because when people are on unemployment for extended periods of time, they don't have money. That's the issue, and they have more bills from the holidays. That's why we tend to not see recessions around Christmas. They come by around March. Here you can see that gas prices go down as more people are on unemployment claims. We see that going into the dot-com bubble. Again, the global financial crisis. We're seeing signs of it now. Perhaps what this is, we're on the cusp of what we might see as a large amount of layoffs in the months to come as demand goes away. And my friends, that would mean the demise of the U.S. economy as we know it today. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.